How to get a mortgage with bad credit. The number that decides everything. Most of the modern financial world is built around a single number. Not your income, not how hard you work, not whether you've paid rent on time for the last 5 years. Just a number. Your credit score. And from the time most people first hear about it, they're taught something very simple. High score, doors open. Low score, doors close. So when someone checks their credit and sees a 550 or a 580 or even a 600, something very predictable happens. They stop planning. They stop asking questions. They quietly decide that home ownership just isn't for them. At least not now, maybe not ever. And I want to slow that thought down today, because the system doesn't actually work the way people think it does. It isn't a wall. It isn't a yes or no gate. It's a machine, a system of gears, incentives, and risk calculations. And once you understand how those gears turn, you start to see something important. There isn't one path to a mortgage, there are several. Some paths are slower. Some require more cash. Some involve trade-offs that aren't obvious at first. But the idea that a low credit score automatically disqualifies you from owning a home, that idea is simply not accurate. Today, we're going to walk through this carefully. No hacks, no loopholes, no urgency. Just mechanics. We're going to look at 5 legitimate paths people use to get a mortgage even with bad or damaged credit. And as we go, I want you to notice something. Every single option is about balancing risk, time, and money. When people make bad real estate decisions, it's almost never because they're unintelligent. It's because they feel rushed, and urgency is expensive. So let's remove the urgency and just look at the math. How lenders actually think. Before we talk about loans, we need to talk about how lenders see you. Banks are not emotional. They're not judging you. They're not punishing you for past mistakes. They're doing one thing: estimating risk. Every loan decision comes down to a few questions. How likely is this person to miss payments? If they do, how much money could we lose? And who absorbs that loss? Your credit score is just a shortcut, a compressed summary of past behavior. It's not the full story, and lenders know that. That's why there are different loan programs, different underwriting standards, and different ways to offset risk. If one variable looks weak, another can be strengthened. Lower score, maybe more cash. Less cash, maybe more time. Messy history, maybe stronger current behavior. Once you understand that, the process becomes less intimidating and more strategic. Now let's walk through the first major path. Pillar 1, the government-backed path, FHA loans. Let's start with the most common and most misunderstood option, FHA loans. The Federal Housing Administration does not lend you money. This is important. What they do is insure the loan on behalf of the bank. And that single detail changes everything. When a bank knows the government will step in if the borrower defaults, their risk calculation changes. Suddenly, they don't need a perfect borrower. They just need a manageable one. This is why FHA loans allow much lower credit scores than most people realize. Here's how the structure works. If your credit score is 580 or higher, FHA allows a down payment as low as 3.5%. If your score is between 500 and 579, FHA still allows financing, but requires 10% down. Notice what's happening here. The system isn't rejecting you. It's asking you to rebalance the equation. Lower score equals higher perceived risk. Higher down payment reduces that risk. That's it. No moral judgment, just math. Now here's something people rarely talk about: interest rates. With conventional loans, bad credit usually means aggressive rate penalties. The bank protects itself by charging you more every month. FHA loans work differently. Because the loan is insured, interest rates tend to stay relatively stable across score ranges. You're not punished nearly as harshly for past mistakes. Is FHA perfect? No. You'll likely pay mortgage insurance for the life of the loan, and there are property condition requirements that can complicate certain purchases. But for someone with damaged credit who wants a legitimate, regulated, widely accepted path into home ownership, FHA is often the first door that opens, not the last. Pillar 2. Manual underwriting. When a human reviews your life. Now let's talk about a path most people don't even know exists. Manual underwriting. Most mortgage decisions today are made by algorithms. A computer reviews your file, checks the boxes, and gives an answer in seconds. But when the computer can't decide, or when your credit profile doesn't fit neatly, the file can be reviewed by a human underwriter. And humans can see nuance. Manual underwriting focuses on alternative trade lines, evidence of real-world responsibility that doesn't always show up clearly in a credit score. Things like on-time rent payments, utility bills, insurance premiums, cell phone plans, consistent memberships. They're looking for patterns, not perfection. Have you shown stability? Have you paid obligations consistently? Does your behavior today look different from your past? Because this process involves more uncertainty, the requirements are usually stricter in other areas. Often 10 to 20% down payment, strong proof of income, stable employment history, more documentation overall. This path takes time. It's slower, it's more paperwork heavy, but it's also one of the most honest ways to qualify for a mortgage, because it evaluates how you actually live, not just how an algorithm scores you. If you're not in a rush and you're willing to document your financial life carefully, manual underwriting can quietly open doors most people never knock on. Pillar 4. Strategic credit optimization. Sometimes the smartest move isn't a different loan, it's a better version of the borrower. But credit improvement doesn't mean magic, it means precision. Many people waste months or thousands of dollars trying to raise their score the wrong way. Generic credit repair letters, random disputes, guesswork. Mortgage professionals use something much more targeted. They use credit simulators, tools that show exactly which actions will move your score the most. Not pay everything off, not open more accounts, specific actions. Lowering utilization on one card, paying down a balance by a precise amount, correcting a specific reporting error. Utilization alone, the percentage of available credit you're using, can swing your score dramatically. Above 30%, lenders see stress. Below it, they see control. And errors matter more than people think. A significant percentage of credit reports contain mistakes. Fixing one inaccurate late payment or outdated balance can sometimes add dozens of points. This isn't gaming the system. It's making sure the data being used to judge you is accurate. If you can give yourself 6 to 12 months to clean this up, the long-term payoff can be enormous. Pillar 4. The no-bank path. Creative finance. Now let's talk about paths that bypass banks entirely. Owner financing. Subject-to deals. These strategies don't rely on credit scores because they don't rely on institutional lenders. In owner financing, the seller becomes the bank. You negotiate terms directly: down payment, interest rate, repayment schedule. In subject-to deals, you take over the seller's existing mortgage, usually because they need to exit quickly. These strategies can work, but they come with trade-offs. Interest rates are often higher, contracts are less standardized, and legal review is essential. You're paying for flexibility. Creative finance is not a shortcut, it's a negotiation, and like all negotiations, it rewards patience and clarity, not desperation. Pillar 5. Time, strategy, and patience. Finally, let's talk about the most underrated tool in real estate: time. Sometimes the best financial move is waiting, not because you failed, but because you're repositioning. A higher down payment can unlock better loan terms. A shorter mortgage term can reduce interest dramatically. A year of preparation can change the cost of the next 30 years. Waiting isn't inactivity, it's strategy.
If improving your score by 60 points saves you hundreds every month, that's not delay, that's leverage. Conclusion: you are not disqualified. Getting a mortgage with bad credit isn't about beating the system, it's about understanding it. Lower score means one set of trade-offs, less cash means another, limited time means a third. None of this is a moral judgment, it's math. And once you understand the gears, you get to choose which one to turn. Don't let urgency make the decision for you. You're the one paying for the next 30 years. I'm Ben. Let's keep slowing money down and looking at the math.